Welcome to The Explainer. Today, we're going to break down exactly how Canadian business owners can navigate the pretty complex world of equipment financing in 2026. We're talking about everything from locking in the best rates to understanding those critical little differences that can save you a ton of money. So here's our game plan. First, we'll get a handle on the big picture, what the market looks like in 2026. Then, we're going to dive into that big decision. Should you get a loan, or is a lease the smarter move? After that, we'll decode the real costs and unpack some powerful tax benefits. And we'll wrap it all up with a clear roadmap on how to actually get your application approved.
All right, first things first, let's set the stage. To make the best financing decision, you've got to understand the environment you're operating in. And right now, the market is, well, it's definitely in a state of flux.
Yeah, industry experts are seeing a pretty major shift. See, after a few years where competition was fierce and maybe a little too aggressive, a lot of lenders are getting more cautious. They're pulling back. So, what does that mean for you? It means they're looking at every single deal that crosses their desk way more closely than they used to.
This all creates a really interesting paradox for business owners in 2026. On one hand, you've got some good news. As inflation starts to calm down, the headline interest rates, your basic cost of borrowing, are finally looking a little friendlier. But, and this is a big but, on the other hand, actually getting a yes from those lenders, that's getting tougher. It requires a much stronger business case than it did just a couple of years ago. And hey, this isn't just some minor shuffle. We're seeing some serious consolidation out there, with huge players making big moves. This whole pattern is actually reminding some experts of what happened after the 2008 financial crash. For you, it could mean you'll see fewer financing partners to choose from, but the ones that are left might be more stable. Okay, so with all that change in the air, you, as a business owner, are standing at a pretty critical strategic crossroads.
And let me be clear, there is no single right answer here. There just isn't. It really depends entirely on your specific business needs, the lifespan of the gear you're buying, and of course, your long-term financial strategy.
So, at a glance, the choice seems pretty simple, right? A loan means you own the thing and you build equity. A lease gives you flexibility, usually with lower upfront costs, and you treat the payment more like a rental. But the real story, the one that can save you a ton of money, is hidden in the details, especially when it comes to your tax bill.
Okay, check this out. This is where it gets really interesting. Look at this example for a $100,000 machine. The loan actually has a lower interest rate, 3% versus 5% for the lease, but follow the numbers down. Because the lease offers way better tax deductions, its final net cost, right there at the bottom, is actually lower over 5 years. Pretty wild, right?
And hey, don't for a second think this is just a small business play. Major public companies, like the mining giant Hudbay Minerals, carry over $77 million in lease liabilities on their balance sheet. That just goes to show you it's a powerful and super widely used tool for managing huge assets and optimizing the books.
All right, so you've weighed the pros and cons of loans versus leases. Let's get down to brass tacks. What kind of numbers are you actually going to see on a proposal?
For your typical Canadian business, solid credit history, looking to lease a piece of equipment for under $100,000, this 7 to 9% range is kind of the ballpark you should be expecting to see in 2026. Of course, if you've got amazing credit, you might get closer to 5%, while riskier profiles will of course be higher.
But that rate, it's definitely not set in stone. Think of it as a moving target that gets influenced by everything from your credit scores to how long you've been in business. And here's a crucial one, it's also affected by the equipment itself. A machine that holds its resale value is less risky for the lender, and that can earn you a better rate.
And, where you shop for financing really matters. Your best bet for the lowest rates? Usually government-backed programs through the big banks. Independent lenders, they offer more flexibility, but the rates are a bit higher. And then you've got the newer fintech lenders who can be super fast, but often come at a premium cost.
But here's the thing, and this is absolutely crucial to understand, that interest rate is only one part of the story. The way your financing is treated by the Canada Revenue Agency, that's where you can find some truly significant savings. Okay, this slide right here, this is probably the single most important tax difference you need to know. With a loan, you can only deduct the interest part of your payment. But with a lease, the CRA sees the entire monthly payment as a regular operating expense. Think of it as a cost of doing business. That means it's generally 100% tax deductible, which can really accelerate your savings.
And it doesn't stop there. Leasing also completely changes how you deal with sales tax. Instead of paying one giant GST bill right up front, you pay it in little bits with each monthly payment. That's a huge win for your cash flow.
And it also means you can claim your input tax credits, that's getting the sales tax back from the government, every single year of the term.
Okay, deep breath. So, you know your options, you get the real costs, and you see the tax advantages. Let's wrap this up with the most important part. How do you prepare your business to get the absolute best terms from a lender?
Lenders are completely unanimous on this point. Showing up with messy, disorganized, or incomplete financial records, that's the fastest ticket to a higher rate or even worse, just a flat-out no. Seriously, investing in a professional bookkeeper or a CPA isn't a cost. It's an investment that pays for itself and then some with better financing terms.
To get approved in this tougher market, you have to tell a compelling story that's backed up by numbers. It's a three-part story, really. You need to show them where you've been with historical financials, where you are right now with current statements, and most importantly, how this shiny new piece of equipment is the key to where you're going. And you can bet one of the first numbers they're going to look at is your debt-to-equity ratio. This number basically shows them how much debt you're carrying. Keeping it in that healthy range, usually between 2 and 3 for a lot of industries, proves that you can take on new payments responsibly without being overstretched.
So, at the end of the day, getting the right financing in 2026, it's not really about just hunting for the lowest rate anymore. It's about preparation. It's about being able to prove to a lender with clear data and a strong story that your business is a smart, stable, and forward-thinking investment.